All right. Good morning. Good morning. First thing in the morning. It's nice to see you guys here. Now, I said we were going to do a little bit of seasonal nature of markets today, but then I realized we haven't talked about that's why we don't do seasonal nature markets very often, is because we just got so many other things to work on. And, finding new things to trade is not one of them. That's what seasonal says, right? It's like, well, we don't know what to trade. Let's go find some new things to trade. Well, there's so many things to trade right now. I decided to push that seasonal stuff off one more time, and we're going to do poor man's covered call. All right. The reason we're going to do poor man's covered call is because we got a lot of them going. That's why there are a lot of opportunities for them, is what I guess I should say. So the first thing I want to do is I want to come in here and I want to open up our portfolio. This is just the current positions that we have. I have an empty portfolio. It's just called Portfolio 58. We'll just come in here and rename it to Poor Man's Covered Calls. All right, so we're going to name it Poor Man's Covered Calls, and then we're just going to come in here and we're going to open up everything we've got. All right, we're just going to open up our entire portfolio. So I'm just going to go Control A like that. That's how I do that. When I've got my accounting window down here, these are our positions that are open. I just click it down in here and highlight one and then hit Control A. That selects everything in the whole positions table. Then I just right click and I say Open Charts. And now that'll open up here every single chart that we got in our accounting window. Oh, we don't have as many as I thought we did. Okay, well, that's all right. So what are we up? We're up 20 grand. And so the situation here is that we bought all of these long calls basically right down here at the bottom of the market as it started to turn, right? Because we're smart. We knew that's what was going to happen, kind of, right? We had a good inclination that this market was going to turn right here. So we bought lots of long calls. Now I'm going to skip BMY because that was a lesson and I don't like it. We got our heinies handed to us. This is what happens when you don't trade, when you trade at times that are not decision points. Remember yesterday, for those of you who came and attended class in the afternoon for our day trading class, I mentioned decision point trading. Now, what is decision point trading? Decision point trading is that you should only be making decisions to make new trades at decision points. All right. Don't be making trades halfway through a trend. All right. So the decision points are the times where the blue lights or the yellow lights, whichever lights you're using, break the trend. All right. So right there, that's a decision point. Here's 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 a decision point. These are all decision points where you have to make a determination whether you think the market's going to go up or down at these decision points. Now, the way you read the market is you say, well, the trend is your friend until it bends or ends, right? I kind of even bends. I like to take that one out. The trend is your friend until it ends. So if you come in here, we talked about this yesterday. Let me see if I can make this bigger for you. Let me get down here. So if you come down here, you got one up for every down. And that's how the market works. It's one up for every down. Now, the problem is we don't know how big an up's going to be. We don't know how big the down's going to be. All right. But it's one up for every down. Now, these little blue lights in here, the ones I've got turned on now, we used yellow lights yesterday. We used the ATR in the day trading. But today we use the blue lights, which is for the longer term charts. This is daily chart. So I like to use the blue lights and the bulls and bears on the daily charts. And then when we go down and do day trading, I'll switch over and use the ATR, the average true range. I have a little bit more control over the ATR because the bulls and bears is been tuned in for the Aladdin BlackRock algorithm. That's what I've done with it. That's why the bulls and bears is what it is. It's a mathematical model that's trying to reverse engineer the BlackRock Aladdin algorithm. All right. And that's the way I created it a long time ago when I created it. And I didn't invent it. I got the formula from a guy at the Chicago Board of Trade when I was working there. All right. So when I was back in Chicago, I got to talk to lots of traders. And this was a thing back then too, that quants and trading systems were starting to take over and start to trade. Now, this is how we tune this thing in. And it took us a lot of work to kind of get it fine tuned in. The formula was given to me, but we didn't get it fine tuned in until years later. But I like to put it on the progressive. And then the setting is sensitivity 72. All right. If you put it, you can change it. You can move it around and kind of adjust it anywhere you want. But if you put it on 72, right there, that's where we've discovered that it kind of works the best with the with what we consider to be the Aladdin Borg-like model. All right, where we're doing all the old school, as it's been called, the old school Elliott wave, um, Fibonacci, delta cone probability stuff. All right, and that's what we've discovered, that's very much follows what the market does. And I believe, and I've wrote these articles in Pit News Magazine, that it all has to do with the hive mind of the Aladdin algorithm. They control everything. They control the whole world, and now they're starting to license that Aladdin system out to all the other big firms. So they're all working, doing the same thing. Now they're all kind of working against each other too, but now they're all kind of working together at the same time, almost like the Borg, kind of like a big hive mind. So that's why the market has become so much more predictable lately. Now, there's obviously things that'll pop in and pop out and make the market do things that that nobody can control. But for the most part, it's pretty much driven by the algorithms. And, that shouldn't surprise anybody. I mean, talking about AI and artificial intelligence, and you can see that all right now. But this has been going on for years and years and years. I mean, we've had computers trading these big money traders forever. I mean, it seems like forever. Every 20, 30 years, we've had computers trading the stock market, right? So it's just gotten more and more and more prolific as time goes by. And as that happens, more and more and more and more money gets controlled and traded and handled by the computer systems. It's going to be more and more and more and more predictable. All right. Now, obviously, there's always things that are going to come in and throw things off, but they're going to kind of reset it and come back in and start controlling the market again. So that's why I say decision point trading. So if you're trading outside of these decision points, you got a really low possibility that you're going to be right and make money. All right. So just keep that in mind. You want to always be making your decisions to get in and out of markets at these points here. Does it mean add on? No, you can add on at different places and different locations. There's different reasons why you might want to add on to a position or take positions off, scale in and scale out. But for new entries, these are your locations called decision points. And it's where the markets are breaking these blue lights. All right. And if you want to come down and make these blue lights a little bit less sensitive, so you're not, jumping in and out as often, there you go. There's a very long set of blue lights, and you'd stay in that entire time, and you'd only have one decision point, right in here. So there'd be your decision point. There'd be a decision point. Now, but if you want to follow the Aladdin the Aladdin system, all right, the BlackRock system, this model was given to me, and we've tuned it in to number 72 right there. That's the Aladdin model. All right. So what it does is it buys and sells, has areas where it gets in, gets out, gets in, gets out, and manages money. That's how it does it. Now, it's not just one formula. They have many formulas, but this is the one that we want to work with ourselves for our long-term investing. All right. So we can make these trading decisions. So AMD right here is coming into a decision point right here. All right. It's getting ready to cross and break those blue lights. That's why I keep talking to you about, it's got to break the blue lights. How important is it that it's going to break the blue? Well, it didn't break the blue lights. And so I can't do anything. It didn't break the blue lights. Damn it. I wanted it to break the blue lights. You hear me say that all the time, right? It's because those are decision points. Those are points in where the market's going to make a decision. Now, is it going to go up or down at that decision point? We don't know. We're going to make our best guess, right? We're going to count how many times it's gone down. We're going to count how many times it's gone up. We're going to count the Elliott wave patterns. We're going to count the Fibonacci numbers. We're going to do all that work, all that mathematical model, so that we can make what I always call a swag, right? A scientific wild ass guess. Because everything we do in this market is a wild ass guess. Nobody knows what the market's going to do. So at these decision points, we have to, based on past performance. Now, we all know that past performance is not necessarily indicative of future results, but it's the best we've got, right? So we look at past performance, and then we try to decide what the market's going to do based on technical analysis. Now, you can try and listen to the news, and I've got an article in Pit News Magazine this month talking about the news and how the news is just the cover story, because the market moves, and then when the market does something, the news jumps on and tries to tell you why it did it. They usually fill you full of a bunch of bullshit. They don't know. They're just making their best guess. They're saying, the market fell. Let's go see what happened in the news. Donald Trump is working on tariffs. That must be the reason why the market fell. So they just assign something in the fundamental thing so that they can sell you new cars and soap. That's what the television media is all about in the news. They don't know. They have no clue. All right. They only know what BlackRock tells them. And then they can look around and they can say, the market started to fall. Let's look out in the world and see what's bad, all right? Because the market's falling, something bad must have happened. So they'll look around, oh, Donald Trump's working on, and we hate Donald Trump, the mainstream media, they all hate, oh, it must be something Donald Trump's doing. If the market's falling, what's he doing? Oh, he's working on tariffs. Oh, the big story is the market hates Donald Trump because of tariffs. But really, it has nothing to do with what Donald Trump's doing, or very little. I mean, obviously, some of the new policies can shake up the stock market for sure. No doubt about that. But for the most part, for these smaller term moves, these trades, the way the market works, it has to digest trades, it has to take profits, it has to accumulate more float. All this kind of stuff that we've talked about in the past is all driven by these big algorithms. All right. So as these algorithms come into their decision points where they have to start digesting the trade, we look at them and say, well, how far do these markets generally go? So if it's going to come in here and break this blue light, we're going to anticipate that this market's going to fall. Now, we talked about this on Tuesday morning's class, and I said I didn't have enough time to do it, but I wanted to get these positions on. All right. So I put these positions on because I was anticipating that the market's going to get up here and break these blue lights. Am I right? I don't know. I'm making a scientific wild ass guess. I'm guessing that the market's going to fall and pull back right here. Could it keep going? Sure, it could. Hasn't broke the blue lights yet. But I'm anticipating that this is a kind of a blow off top and it's going to come back and break that blue light. And if it does, I'm anticipating that it's going to come back down into the one standard deviation, right? We talk about the one standard deviation all the time. So here we go. There's the one standard deviation. That's where I'd expect the market to fall to. And so what I did, because we got a long call right here, so we got in with our long call right here, and we're making lots of money. See, let's just come down here and show the single one. Making lots of money on this one, $5,200. How many did we put on 5? They were 80. We paid $10,000. So we put $10,000 in calls on AMD right here as the market started to break higher into this yellow zone, coming out of this little ABC pattern, right? And we're anticipating a rise in price. So this was our head and shoulders formation. It's like, Lan, what made you decide to get in there? Well, it was a decision point right here where the market broke, right? And it came in and it created this little funny, it was kind of a funny little pattern like that. That's a little head and shoulders formation. I generally like to see those a little bit better formed, but that's what it is. The market is what it is. You can only do what it can do, and that's what it did. But it came down here with this natural headline. This is your left shoulder. That's your neckline. That's your head. That's your neckline. That's your right shoulder. Very steep, but it broke right there, and that's why we put those calls on, right? So we put those calls on, and I put a bunch of these on in my own personal, this is the class account, but I put a bunch of these on in my real money account as well. So I'm doing the same thing with my real money. And so this comes in here, and what we do is in the class, we put them on a lot of markets. We go in and we try and, we put things on lots of things that we might not want to really be doing. But that's okay. We're putting them in on the class. And then we can go through and we decide, oh, hey, I like this one. I like that one and that one. So these are my 3 favorites out of the 10 that Lan put on. Okay, I'm going to take the 3 favorites and put those on in my real money account. The other 8, the other 7, okay, I'm just going to let them run over here in the demo account and see how they would have turned out. Oh, well, I would have made a lot of money on those too, but I picked good. I picked well. I picked wrong. These are the 7 that I didn't pick make money. The 3 that I did pick lost money. So then you have to reevaluate why. What was it you were thinking that was wrong about? Why'd you pick the wrong ones? But you want to have all of them running at the same time, right? So you want to make sure that you keep a demo account running, going with things that you think would have been good trades, but you really didn't. And then you can pick from the ones you like and put in your real money account. That's how you got to do it. You can't just say, oh, I only trade real money. Guys that tell you, oh, anybody who has a demo accounts, they're pussies. No. You got to have a demo account. Everybody has to have a demo account. Whenever you get a track and trade software package, it comes with a demo account. And there's a reason for that. You have your demo account so you can put on 10 different things, 20 different models. You can have 30 different things going over here in the demo account that you're following and you're tracking and you're working your math and you're doing all your stuff and you got it all running and you can watch all these different markets, and then you pick. And then you come in and you say, I'm going to cherry pick out of my big model just the very best ones and put them in the real money account. How else are you going to know which are the very best ones if you don't have 30 of them running? And you can't have 30 of them running in your real money account. That wouldn't make sense. So you got to pick and choose out of the 30 that you got running that you've chosen. It's called research. All right. You guys ever heard that word? It's called research. So you do all of your research in the demo account, and then you cherry pick the very best ones out of your demo account and you put them in your real money account. All right, that's how we do it. So everybody who says, oh, you're wasting time in the demo account. No, we're not. We're not wasting our time. We're doing research. All right. It's a very important component of trading. So you have to do it. And that's how you keep your skills sharp too. So if you're going to go over and you're going to be a day trader and you're going to scalp like we did yesterday afternoon, well, you want to do a lot of that in the day trading. And you're not feeling like the market's working, performing the way you want it to today. I don't feel good. Maybe feeling a little under the weather, but I want to sit and watch the markets. Maybe the markets aren't doing well. You're like, the markets suck. Well, that's when you go over and you day trade in the you scalp in the demo account, just to keep your skills sharp. It's like, if you sit there and don't trade for 3 months and then come back in and start trying to trade again and say, well, today's a good day. I think I'll trade. I think I'll day trade. I haven't traded for 3 months, but I think I'll come in and do it. No, you're going to probably get your hiney handed to you because you're not sharp. Your skills are not there. You have to keep doing it in the demo account so that your skills are sharp and ready and you're active and you're good at this. It's like flying an airplane. I'm a pilot and I go down to St. George and I can't take my airplane down there. I've tried to take it down there, but it's not. I've taken it down there a couple of years, but oftentimes I'll leave my airplane up here. And so up here in Logan. So now my airplane's out here and I haven't flown up for it's been like 3 or 4 or 5 months since I've flown my airplane. And now the first time that I got to go get back in my airplane, a little scary, right? I'm like, I haven't flown for 5 months, 6 months. I'm a little scared here to get back in my airplane, start flying it around again because I'm rusty, right? And I have to go up and I have to get current again and I have to go do my landings. I have to go out and do my in my stalls and points around a turn, practice and get skilled again before I even dare put somebody out in the airplane with me. It's the same with trading. If you don't stay focused on it and you're not doing it all the time, your head gets out of it and you forget things. I forgot more about the market than most people know. All right. Because you kind of focus your attention in on what's important and all that other stuff can go away. And you have to be concentrated and be constantly working it so that your mind is into it all the time. That's the way trading is. And if you don't want to do that kind of trading, then just do investing. And that's okay too, where you just, throw money into something like JEPI or JEPQ or, some of those a little bit more fun funds, but they're just long-term growth and you just throw money into them every couple of weeks and you don't look at them for 5 years. You can do that kind of trading. That's okay. But if you're in this class, I'm assuming that's not you. You're the kind of guy that wants to be actively involved in managing your money and you want to be trading. You want to be a trader. Otherwise, you wouldn't be in this class. You'd be in some other guy's class. All right. Or in no class at all. So this is a very active investing class, and we're going to use our mathematical modeling to make our very best swags. And this very best swags come in at those decision points. And the decision points are where these blue lights are breaking. Now, so the idea here is that we got in with our long calls. We got 5 of them. And now the market's starting to rally up. And it looks like to me it's going to come back down into the Delta Cone probability. Now, it might be a little bit early, but we want to count our little mountains, right? We generally anticipate 3. So 3 drives. So there's 1. And there's really not another one, is there? It's kind of like, well, you got one little tiny pullback right in there. This market was really strong. And then we got another really big mountain little here. But it looks like right in there. And the other markets that are making the same pattern have a little bit better formed 3 drive pattern. So we could take that into consideration as well. So we think overall, and if we want to come in and look at the S&P 500, SPY, which again, remember, this is the granddaddy of them all. This is the backbone. This is the spinal cord of the financial markets. And so if we come and look at this one, we can come in and we can draw our nice little natural trend lines in here. And we can see this one has our 3 little drives in here as well. So we'll point those out with little mountain things here, little mountains. All right. So we got little drives like this. So we got one more. We got another one to pull back here. It's a little bit better for them, but still, it was really quite strong. That was a strong run right in there. Oh, come on, little silly thing. Come on, give me what I want right here. There we go. So there's our 3rd little mountain. And if we come in here and we take our GAN fan, remember we talked about GAN fan? GAN fan tells us that the market has to be within this zone right here. All right. So if we take this little thing, we're going to go like this, here, here. And so this is kind of our cone, let's call it the GAN cone of probability. All right. I'm losing my voice. Hold on a second. Let me get a drink of water. All right, so this is our GAN cone of probability, and this thing's got to come in here between 1/2 and 2/1. All right, so as long as the market's going in there, and look at this, this market is absolutely like a train on rails, riding that 1-to-1 right up the trend. Now it's getting up there with 3 drives: drive 1, drive 2, drive 3. Now this could be a little break right here. We get these little breaks right here, and this ends up being just all the one A1 right here: A1, A2, A1, A2. We could go into an A3. So this is I'm calling A1, this I'm calling A2, and this I'm calling A3. But if we just call this whole little red thing here A1, that would make this A2, and this would be A3. So there's actually some additional upside potential on here, depending on how this thing gets counted out. This little thing always screws me up, where we get the break of the blue light and then it flushes back down and starts a new point. So we end up with this little, that let's draw it out a little bit better. So what happens, this is always confusing to me. And I don't know. It depends on how the quant systems are going to count it. So this ends up being the A1, right? So if this is A1, and of course it's X2S A1. So that's the nomenclature for this pattern right here. And that's because we got this first drive coming down. So drive 1, this is drive 1, this is a counter trend, drive 2. So this is drive A, drive B. So this is the second exit to the drive B, right? So you're getting out of the market here in anticipation of a third drive. But Elliott wave theory tells us that we're generally going to come down with an ABC off the backside. And that's what this is the backside in anticipation of a reversal. So we got the classic ABC pattern off the backside, and it becomes right here. This becomes right down in this little hole right here where this blue light crossed. This becomes X2SA1. Now the question is this actually X2SA1 over here? Or is this X2SA1 over here? I don't know. I don't know where to put my X2SA1 because sometimes it's over here and sometimes it's over there. I don't know which side of that little peak. I don't know whether to count that peak as our first A1 or is this A1? Because if this is A1 right here, this is A2, this would be A3 up here, and we'd be going into a third drive. We don't count this one. This would be drive 1, drive 2. See, so this little thing always screws me up, and I'm not sure how the quants are going to count it because sometimes you get 3 drives like this and sometimes you get 2. And then you have to count this one. This becomes your first A1. So A1 becomes over here. And I usually count this was A1 on the inside of the blue light. That's generally how it turns out. So this ends up being A1 like that. And then this is A2 over here because we generally get 3 drives. All right. And sometimes it's very clear and you don't have to wonder. It's just like, oh, well, it's obvious. But when it does this little funny little break right here and then flushes and doesn't just kind of swing, like see how it swings very easily. Most 90% of the time it's real obvious. But every once in a while you get this little funny thing in here where you're like, I don't know how they're going to count that. And so that's what we're trying to do. We're trying to reverse engineer, right? We're trying to reverse engineer what the market's doing. So all we can do is make our best guess at this point. We don't know. We're gonna have to wait and see until the quant system decides whether that was an A1 here or an A1 here. So I'm going to call this A1 here, A2 here. And that's why I made my decision point up here. This is A3 right here. And once we get the third drive, go into the third drive, if this is A3, that means we have drive 1 right here, drive 1. This is drive 2. This is drive 3. But because of that, this could be, we might have to make an adjustment. This thing could go up and make one more drive up. Could do that. All right. But I don't think so. I think that blue light's coming up in there, and it could. We don't know. We don't know. It could always go up more. All right. But I think it's going to break. I think it needs a break right here. And I think it's going to come down. I think it's going to break those blue lights, probably do a little one of these things. I think we're going to get it down here to 2-to-1. I think this is going to be our target area down in here. If we draw our Fibonacci ruler in there and put in that delta cone of probability up to the peak, see, the thing is we got this high up here. I think it wants to test that high. We may see it do that too. If not, it's going to come down, maybe hit the 38.2, get it back down in here, and then start doing one of these and going back up. That's okay. As long as it breaks the blue lights, we'll be happy. That's all we want. We want it to break those blue lights. And it needs to do that. It needs to flush a little bit more. And so that's why the point of bringing this all in here and showing you these models is that we might have one more drive in us, all right, because of this screwed up thing here. But I'm going to call it that as one drive, drive 2, drive 3. It may not be. This may be all just A1 might be right here. If that's the case, but see, the natural trend line is right in here, and it broke the natural trend. It's trying to break that natural trend line today. So we'll see. We'll have to watch and see, but I think it's going to come down. I think we're going to intercept right in here. We're going to break that blue light, and we're going to come down and get a 38.2 retracement. Maybe even a little bit more. I don't know. I don't think it'll come. I don't know. You never know how far they're going to pull the market back. So back into that Fibonacci sweet spot anyway, nonetheless. And so that's, send it back. Let's get this little circle out here. So this is the actual delta cone of one standard deviation delta cone of probabilities right in here. All right. So technically speaking, once it breaks those blue lights, that's where it should come. It looks like it might be a little bit out here. I don't know. Just try to guess where they're going to drive that market down to. All right. So they'll let it fall. They'll drive it down here, go into the accumulation. This is the A drive will be over, and we'll start moving into the B drive. So in that's why I come back over here to AMD, and that's why I put this sold a call up here. All right, because I think the market's going to break those blue lights and it's going to flush back down. So we're going to do the poor man's covered call, but you don't want to just, as soon as you put on your calls, put on the puts or put on the sold calls. You don't want, as soon as you buy the long calls, you don't want to immediately jump in here and put on the short puts or the short calls. And the reason is because you don't know if you're anticipating an acceleration up into this market. There's no reason to cap out your profit potential of the long call. Wait until it gets up here to the first drive, that A drive, which is going to have that nice pullback, and then that's where you want to put your. So just wait. You know, there's an article in Pit News Magazine, and Claire did a podcast on it the other day, and it kind of, you know, brought that home. How many of you saw that podcast that Claire put out in the Pit News on Air podcast? How many of you guys have Pit News on Air podcast? You got to have it here. It'd be a good time to talk about it. Let's come over here to Pit News Magazine. And if you come to Pit News Magazine, this is where you subscribe to the magazine right here. And this is where Claire's got her new on-air podcast. So click on that, and it'll take you over to, I don't know what this is. This is the Pit News podcast right here. So now you got all these podcasts that are coming out, and she's putting one out every week. All right. Every Wednesday, you get a new Pit News Magazine podcast. The magazine only comes out once a month, but her podcasts are coming out every week. Every Wednesday, she posts a new one. She just posted a new one yesterday. All right. So there's Pit News Magazine. Claire's in charge of it. She gets to do it all. She gets to narrate it. So I don't have to, but there's how you get subscribed to it. And it's free. It doesn't cost you anything. So it's a lot of fun. So Kirk says he has both the Pit News Magazine and the podcast. I hope you're enjoying both of them, Kirk. Glad to see that you have them both. And that's how you can get the podcast. So she talked about the podcast. I think if you go over here, I don't know why it keeps pulling this up. Allow Spotify to open Spotify link in Spotify. Oh, it wants to open up in the program. So anyway, so this one here, not the news, trading panic turn into grown up strategy. I think that's it right there. Go listen to this podcast. She just got started. There's only 3 of them out there, 1, 2, 3, but this is their first month. So listen to that podcast right there. It'll talk about, I think that's one about waiting for the market to come to you. I think that's what that one's about. All right. So wait for the market to come to you. And then you can have put your option on up there. All right. So what are we up on that option? Well, we're down $390. Oh no, we bought the call. Wait, buy the call. Oh, wait a second. Did I buy the call? Oh no, I made a mistake. I bought the call instead of sold it. Oh no, I can't believe I did that. Lan, oh, you're so dumb. Let's go see if I did that on the other ones. Did I buy it? Oh no, I did it right here. Just on AMD, I bought it instead of sold it. How did I make that mistake? Oh, well, Lan's not perfect. Okay, we sold it here. Let's see if I did. Let's go Cisco. Did I buy it or sell it? I sold it here. Misty. Oh, that one was getting in. NVIDIA. I sold the call here. SMCI, I sold the call there. SPY, we didn't do one. So on these, at least I did them all right on except for this one. The dumbass. All right, let's get rid of that thing. That's not what we want. Take our 385 mistake off the table, and let's try and do it right. Let's see if we can. We're going to come in here. The only one we got available to us is 29 days. We'll come down here to the options chain. We'll look at it, but we've already this thing. Look at this one. Look at how many. 23,000. What's going on there? Let's see if we sell that. Are they selling that right there? Are they buying it? I don't know. That's stupid. Why have they got 23,000? They must be selling them. Well, let's sell them a little. Let's sell ours. Look at, oh, this is the sells up here. Look, these guys are selling them up there. That's what we want to do. We want to sell. Look how many's up there. They're selling them for $400. Let's go up. Oh, look, here's some more. Oh, look up here. They're selling them way up there too. We like that. That's a little bit more cautious. Like your delta is 0.32. Your implied volatility is, let's see, probability of being out of the money, 67%. Probability of being in the money is 32%. So we got a higher probability of being out of the money, which is what we want. We want this market to drop. If we anticipate it going to break those blue lights and continue to fall, we'll make money on here. Depending on how aggressive you want to be. Now, this is AMD. We got 5 of them, so we don't have to, we can put one. Let's see. Let's break it up. Let's put, let's sell a call. Sell a call. Yeah, we can sell one. Where are these guys putting all theirs? Right here. We're going to go one above it because oftentimes the market likes to go up to all those guys and try and scare them out. So if we go one above it, then we don't get scared out. So that's 397. We can do one of those. And we got how many? 5. So we got one there. That'll give us $395. Look, there's some more right in there. We'll sell another one there. So that would be, that's 3. Do 2 more. Let's do 2 here. Let's sell another one here. And then let's sell another one here. Oh, it's just going to do it. I thought it would do it. I thought it would. Let's clear these 2. No, yeah, this one here. So we're going to sell. Wait a second. I thought I already had one there. Okay, we're just going to increase the quantity on this one. Oh, I want to increase the quantity on, which one is this? The 264. I need to open this up a little bit more. Oh, no, there it is. Oh, no, wait. Premium. Oh, 120. 120, we're going to increase that one. 2, 3, 4, we got to increase one more. I want to do it on the 18. 18, that's this one. Okay, so we're going to do it like that. So this one has 2 up here on the top. We're going to sell 2 more here and 2 more here. So we're going to sell 5 because we got long 5. All right. So we're going to go ahead, and we don't have to do them all at once. We can do them as we can leg into the market. We're going to do them all at once. We're going to go ahead. We'll just market into these. Lan was stupid and bought instead of sold. Did that give us our? Oh, it just so they all just rejected. Well, let's try again. We might have to leg into them. Let's try this one more time. We're going to sell. Doggone it. We got these, had these all worked out where we wanted them. We're going to sell here. Is that where we said? Or up here higher? Sell here. And was there one up higher? Ooh. Was it up here? Sell here. Ooh. 135. We could probably come in a little bit more aggressive with this one, a little bit more aggressive with this one, and a little bit more aggressive with this one. Well, the problem with that is then we're right on top of where everybody else is. That's right, why everybody else is right there. Look, they're right. Boom, boom, boom. We want to be one above each one. So we'll go one above each one. One above here, one above here. You don't have to. You can jump on the bandwagon with everybody else, but it's fun to be one above. All right, so now we're going to come in and we're going to increase. We want to increase. Let's see if it'll let us do it all at once again. We're going to try and increase 126. No. Yeah, 126 we're going to increase, and 121 we're going to increase. All right, let's see if it'll. Let's go 1127. Let's go down to 1130. 1143. Oh, that's probably why it's going to reject again. 1139. Okay, see if it'll go. Come on, give it to us. We're going the wrong way. Try that. Come on, give it to us. Am I going the wrong way? I don't think so. Because that would be. Okay. Take them. There we go. All right. I was going the wrong way. All right. So we got them all in there now. So we got all of our positions on. Look at that. There they all are. Okay. So we got our 3 on there. All right. So that was land screw up. Sorry. So now when we come back here, we got our, let's go back into our positions. We got 3 shorts right here. And we're up 5,200 on this. So this will pay us off about what, 4, 5, 6, 7, 8, 9, 10, about $1,000. That's not bad. That's not bad, $1,000. But that's got to. We'll probably take it off early, because if this starts to fall, as soon as it goes, we want to see it fall, break those blue lights, and come down in here. As soon as it makes the first, if it hits 38.2, first candle to make a new high, bam, taking those things off. So take our profits. Actually, I don't even want to wait for it to make the first candle break a new high. As soon as that happens, those things will flush that down a toilet, their price, as soon as that makes one new high. So we're going to have to, as soon as it comes down, breaks the blue lights, flush down into here. As soon as it's down into here anywhere, we want to start taking those off. All right, max out our profit. Because we don't think it's going to, we don't really think it's going to come very far. We just think it's going to come back down. It's just going to break down into here somewhere and then turn and go back up. Start our next drive. And that will be X. No, not X. It's just going to be a B1. All right. So we're looking for a B1 down in here. And that's what we're going to try and anticipate. Where do you get a Lan? What are you talking about with these A1s, B1s, C1s? It's in the manual. It's in the manual. Here's the manual. If you want to know what that is, the manual is out on Amazon. It's 238 page workbook out on Amazon. You have to search Lan H. Turner. If you don't put the H in there, you guys all know the story. It gives you Lana Turner, and although pretty, she's not going to teach you how to trade. So you have to put the H in there, Lan H. Turner, and then this book will come up, and it's not very expensive. It's like $30 or something. So you buy that, 238 pages, all full color, 8.5 by 11. It's a soft-sided, so you can lay it down on your desk. It's a workbook. It's not meant to be read like a novel. It's meant to work through this stuff here. It's got all of this count measure, shows you how to do it, the whole thing. It shows you how to do the Fibonacci numbers, it shows you how to do all of the spider webs, everything. All right. It's all in the book. So if you need the book, go get the book. All right. So that's the manual to the class. And that's the class manual that we use at the university when I teach my class at university. That's the manual. All right. And everybody who comes to my university classes, that's the manual we use. We give you that manual as part of the class. All right. So go get the manual and it'll show you how to do all of these A, B, C, D things. All right, so that one is AMD. Bristol Myers is our sad one. Now, look, we made a mistake on Bristol Myers. What's the mistake we made on Bristol Myers? We bought, look, we got a big down arrow for one right there. And that's the day we bought, the day before we got that down arrow. I guess we didn't make the mistake of not making purchases during. I was going to say that was not a decision point, but it was. We made that decision. I was going to say it was right here in the middle of the trend. Don't make decisions in the middle of the trend. We need to make the decisions at the decision points. But we did. We bought right here as the market was flushing. We bought a call way down here on that day. And didn't turn out for us. And we bought it this day, and the very next day we got a down arrow. So anyway, that's how that one turned out. We're just not very happy about it. It's the loser. You got to have a loser. You can't have all the winners, or else, it's not fair. It's not fair. Somebody's got to take money away from us. We can't take all of our money away from them. You want to be fair when you trade and give somebody some money? No, we don't want to be fair. Heck no, they're not fair to us. Why would we be fair to them? Anyway, this is coming into our this is our little pattern right here. This is our little 2-drive pattern. It's almost a 3-drive pattern. That little break right there. Oh, you know what? We got that one little tiny bar coming there and broke the blue lights. One little tiny bar. But I guess that was okay because look, it came in here and drew that little flat bottom across there, and it broke right there on those blue lights. We should have been short right there, not buying and trying to go long. Jay's like, no way, man. Don't be fair. we don't, we don't want to do anything to give anybody else any money. Heck no, don't be a fair trader. We're going to come down here. So we got to, I don't know. I hate to call this one drive right here, but this is drive 1 here. This is our counter trend. We're coming into drive 2. This is our ABC pattern. So the question is, how far is it going to go down before it starts to go back up again? So it came down, it just that's kind of, it hasn't come down very far, but it did break the blue lights. I don't know. Here's the test. We're going to have to test right here. All right, let's talk about BMI again. BMY. Bowel movement. Yes. Bowel movement. Yes, that's the name of this one. You can remember it. Okay, so let's come in here and let's get rid of these so we can see. View, hide all on-screen options. Okay. Yeah, so we don't want to see them. Okay, so we're going to come in here and draw our little Fibonacci or our little head and shoulders formation. So we got a little left shoulder here, a little right shoulder, a little head, and a little, right now it's breaking those blue lights. It broke them. So we're looking for that right shoulder down here. Now, so the rule on this one is that it's got to break below that head. Okay, so it's got to break that head to continue down, to be in the downtrend. Is it going to be a 4th drive down? I don't know. It just got one little bar that popped up and broke those blue lights. I really don't want to call that a drive by itself, that little topping thing. I want to call this all one big drive. And then but it doesn't matter. It's going to come down. It's going to do its thing. It's got its little head and shoulders in here. Okay, so this is the decision point right here. Now, technically speaking, if this is all copacetic and stays above the right shoulder, this should be our little ABC pattern down off of the drive, the retracement, and this thing should start to go back up right here. It should not break that. If it does, then we're going to have to remove this head and shoulders, and this whole head and shoulders little thing would have to move to the next level like this. All right, so then we would look for the head to come down here, the right shoulder, the neckline would come up, and we would take it to the next level, and then we would draw our little up arrow from here. All right, so that's how these little ABC patterns work. That's how these little head and shoulders formations, they're just counting the ABC patterns, but they're giving you the break. So that's how you read a head and shoulders formation. Okay, so they work very well hand in hand with the MACD. So watch the MACD at the same time, because the MACD is very good at kind of pointing out the head and shoulders formations. So they work kind of hand in hand. But that's where this is at right now. So we're up here at this one. Okay. And that's where we're at. So the little head and shoulders, the left shoulder, the neckline, this is all in here. We're looking for the little right shoulder to come down here, make that little right shoulder, and then break and start to rally once again. Again, if it breaks that head, we have to move the whole thing. We have to throw the whole baby out with the bathwater and start with the next pattern. Just like that. Easy stuff, right? Easy cheesy. Okay, there we go. So that's what we're looking for. And we're in this thing way up here, long from here, long from that down arrow. Oh, what were we thinking? What was I thinking? I don't know. All right, let's turn these back on. View, hide all screens. There we go. They're back. Okay, so we've got in this one, oh, look, we broke the blue lights. That's a good sign. That's what we want. We want that. So we're done with the A drive. And that's why you can look at this as, well, I don't know what's going on AMD. It hasn't broke the blue lights, but is it going to? Well, it's the exact same pattern as on Salesforce, and Salesforce broke the blue lights. So that's why you can kind of read across the market and not just be myopically looking at one market, right? Let's come down here. How did I get up there again? So you don't want to be myopically looking at one market, one chart. So this is, we sold our call up here. We're up $47 on it. We need it to drop a little bit more because we need some time decay on that. The problem is I had to put 29 days on there because that's all we had available to us. All right, we come down here. It's the only one that had quarterlies. Now, could we have come in and done a little shorter, 15 days? Yeah, but look at the volume and open interest. It wasn't very good. And so getting in and out of these things is tough. And I don't think we're going to stay the full 29 days. It would have been nice to get something a little shorter than 29 days with the quarterly expiration, but they didn't have anything available. So it's just timing, just poor timing. See, open interest was not above 1,000. Volume was not above 100. There's just nothing there for us. 15 days, we looked at that one. There's nothing there for us. 22 days, and nothing there for us. See, you have to go out to the quarterly. That's why it's bold in Track and Trade. It has the quarterly, and there's where you're going to find everybody. And they're all right here at these big. Look at this. They're all just like in the last one. They're all at these. They're all piled up at these different locations. Look how everybody's all piled up on here. You can see what they're doing. These are all your covered calls up here. Right here. That's where ours is. There's some more of them there. Look, there's a whole bunch of covered calls right there. There's a whole bunch of covered calls right there. Look, there's a whole bunch way up here, way up here, way up here. They're selling their calls up there. Getting $100. Why not? Do it. It's $100. 15. Look, you could sell one up there. What would that be? Where's that? Way the hell up there. That's probably not a covered call. That's probably a insurance policy for a vertical spread, which is probably, I'll bet you what they're doing is these are a bunch of iron condors out here. These are iron condors. So yeah, that's what those are. Iron condors. So you can see how far away they are from the market. Those are just insurance policies that people are buying for the iron condors. There's some more, probably here too, probably here too. How close is that one? Yeah, you can see these are just iron condors. This might be where they start to, this is the ones they're selling, and they might be buying the ones out here for the legs. You want to do one of those? What are you talking about, Lan? You could come in here, and this is the call side of the iron condor. So you'd sell one here, and they don't have the long position call here. So what they're doing is they're just trying to collect premium. So we've already got one in here. We could just come out, but we're already covered. See, we're covering this one with this one. So we got one here and we got one here. If we wanted to do what they're doing, which is a leg of an iron condor, we could come in here and we could sell. Well, we'd probably sell one. Probably sell one right in here. Let's do one. Where are they putting them? Right here? Right here? Yeah, right there. So they're selling them right there. So let's sell that one, and we would buy this one, right? We come out here and we buy this one. So that would be the upper leg of what I'd call a chicken wing, but it's not really. Yeah, it's kind of a chicken wing because it's only one leg. It's the upper leg. It's just called a vertical spread. So you're going to sell this one, and you have to have a premium to cover it. So you're going to buy an insurance policy for $93, and you're going to receive $340. All right, so you can see in your little calculator over here, you're going to receive 8.23% return on your money in 29 days. That's pretty good. Go down to Cache Valley Bank and say, I would like to get 8.23% return on my money every 29 days. What would they tell you? They would tell you to pound sand, right? They ain't going to give you 8%. They're going to take you 2 years to make that kind of money. 8% at a bank CD. Bank CDs right now are 4%. If you're lucky, they're 3.5%. So you're going to make 8% on your money with basically a 80% chance. Here's your probability of payoff, 80%, with an 80% chance that you're going to get your money. So we can go ahead and we'll put that on just for fun, just to show you. We'll see if they'll let us market into it. Nope, they're not going to let you market into it. It just disappeared. Okay, let's try it again. We're going to buy this one and we're going to sell this one. Is that what we did? That's 6%. Go down. There's our 8% right there. Okay. So the margin requirement is $3,000 though. You put in $3,000, you're going to get 8% on your $3,000 investment, which is $250, and you're going to get that money in 29 days. The way you would not get paid is if this market rallied up and closed above that red line. That's the way it would work right there. See that red line right there? That's why it says it's an 80% chance of making money. So if you come in here, this is not a covered call. This is a vertical spread. And so it's got to stay below this red line and hit that. That's the carnival game right there. Is the little snaky thing, is the little red, green, and yellow snaky thing going to stay below this red line by the time it hits that purple line? That's the game you're playing. All right. Again, it's just a carnival game. Do I think the little red snaky thing is going to stay below this red line? Is it going to hit the purple line before it hits the red line? Is it going to hit the purple line above the red line or below the red line? That's the game you're playing. If it hits the purple line above this red line, well, you lose your money. You don't get anything. You lose your money. All right. But what if it hits the purple line below that red line? Well, then you get all of your money. You get your $250. If it hits it above it, you lose $250. If it comes down here, you make $250. All right. That's the name of the game. It can hit that purple line anywhere along here as long as it's below the red line, and you're going to get your $250. As soon as it goes above the red line and hits the purple line, you lose. So that's the carnival game. That's how this carnival game works. Or these two right here. Not these. These are different. But these two up here. Well, I think the market's going to stay below that red line and hit the purple line first. Okay, well then put it on. If it'll let you. They're going to have to use a credit limit. The two. See if we can figure out the right one. It's selling, so it's got to go to the bid. If they're asking, we're selling. Well, we're selling and we're buying. So let's see. It's got to be the one that's the worst for us. 245. 227, 28, 29, 30, 230. Oh, geez. This is going to get ugly. Oh, no, 267. I'm going the wrong way. Oh, no, I'm not. Oh, you don't have to go that far, Lan. 232. Let's go to 232. See, our spread's $35. All right, let's see if they'll take that. There they go. We were right that time. It's always the one that's worse for you. All right, so there you go. So we got another little strategy on there, vertical spread. That's how that one works. That was on Salesforce. So now we got two strategies on here. Vertical spread. We probably ought to write some notes because I'll come back and go, what the heck were we thinking here? Why did we do that? Let's come to Cisco. Cisco's the same thing. Look at that. Okay, it's getting ready to break those blue lights. Getting ready to break those blue lights. Oh, this one was a lot cleaner. Look how much cleaner this one was. See how this one has the little rally up there and then the pole, and then it broke the blue lights down here. It didn't break the blue lights on this side, which confuses you. And it goes, I don't know what to do. I don't know how to count that, Lan. Then the problem is this thing was so smooth, we didn't have any little mountains. It's all one great big move. It just went straight up. You know what Cisco does? Is it Cisco? Well, Cisco's that. I think they're the food company that delivers all the food to the restaurants. You see all the Cisco. Is that right? Because, oh yeah, Cisco's the food company. I'm pretty sure. What's the one that puts in all of the OpenAI, which is ChatGPT? That company is building a massive data center out in Texas. Have you guys seen that? They're building this massive data center out in Texas. And Oracle, that's one. I always get Oracle and Cisco confused. I keep thinking Cisco is like a tech company. It's not. It's food. I don't know what they deliver food. They bring They bring food to all the restaurants. You see their Cisco trucks out in front of restaurants all the time, wheeling today's dinners into the restaurants. So this is your ABC pattern right here. Come up in here, that's the high point, the low point, back to the high point, and down it came. And it dropped a lot faster. We know, we talked about that. But it did come right down to the magic golden ratio, 130.9. All right. So that was pretty cool. I mean, it's just like a train on rails. It just had a fast train. It was a little bit of a faster train there than we anticipated on that second leg. It dropped really fast right here. And then it rallied up and pulled back, made the little ABC bottom, but the blue light didn't get confused right here and come in early. It just came in right at the right spot, and bam, it went up. That's your ABC, and then bam, up it went like a rocket. Just like a train on rails, just like right out of the manual. Right out of the manual. Yep, right out of the manual. That dumb thing makes me jump big like that every time. That's a new feature they put in the software. Do you like it? If I come over here and show you a picture, and then I want to go back and show you the chart again like that, it won't let me. So I have to remove this, which makes me go full screen and then go back to here. That's a new feature they added to the software. Do you like it? I don't. I wish I could just flip like this, back and forth. Hey, that's our Sunday school lesson. Don't look ahead. All right, but they won't let me just jump now. Now I can't go back to the chart unless I remove this first, and when I do that, it makes me go full screen, and then I go back here. That's a new feature. I don't like that new feature. All right, but I can't design everybody's software. So this is what we're looking for here. Do you want to put another, do you want to put should we see if we can make a little bit more money on this one? There's 29 days. What's the volume look like out there? It looks good. Lots of it. Not very much today, but lots of open interest out here. We could go and put a vertical spread out there. We think this market's going to fall, right? We think it's going to come and break those blue lights, and it's going to flush back down to the Fibonacci sweet spot, which we're going to draw from the very low. We could draw from here, be a little bit more conservative, but technically speaking, we should actually draw it from the very bottom, down where those blue lights broke, like that. Right there. That's where we should be drawing it from. That would put this market back into the Fibonacci sweet spot right in here, right into the delta cone of probability. And if it comes back down into there, well, that means that there's opportunities to make money up here. Is it going to hit the purple line before it hits my red line? Well, where do you want to put the red line just in case it goes up? Well, how high can we go? Well, what's the probability of being out of the money? If you want to go up to probability of being out of the money at 80, there's 90. 80 is only right here. 80 is not very far because the probability is 84 right there. Let's put that in there. If we sold one right there, well, that's clear up there. That's still pretty high. That's above the previous high. So do you think that the snaky thing, this little snaky thing that's going across the screen, do you believe the little snaky thing is going to hit the purple line underneath that red line? If you do, you could make, oh, that's $22. Who cares? Who cares? I ain't going to tie any money up for that. It's a bad trade. Forget it. We don't want to do it. All we're going to look for is this thing to come down here. This one's only going to make $121. We only bought one. This is a tiny little trade. Who cares? Who cares? It's nicely formed, though. You could have done 10 of them, 15, 20, do 100 of them. Who cares? All right, let's come in here. Let's do Misty. Actually, you know what? Let's go do Cisco anyway. Let's go look, because we could do a lot of Cisco. Let's go see, because it's got good volume. That's why these things are so big. That's so few on here, though. Let's do it anyway. All right. Let's see if we can make it happen. Let's come in here. We're going to go into 29 days out. We're going to sell a call. Sell a call way up here. Let's see if there's any volume. Maybe we will. Maybe we'll try. Oh, look, there it is. 22,000 of them are right there. That's where they're doing it. Right there. 94% probability of being out of the money. Of course, they put those on earlier because there's only 0 today. Ooh, let's see. Let's come in a little closer. That's only that's $17 right there. Do you think the little snaky thing is going to hit the purple line underneath the red line? That's the game we're playing. How good are you at guessing where that market's going to go? I think it's going to turn and come back down into the delta cone of probability when it crosses those blue lights. The problem is we don't have any ABCs in here. We can't count 3 drive patterns because there's not any. It's just one straight big up it went. Now, you've got a little bit of a topping pullback here, right there. See that? And you got a little bit of a topping pullback there. So that's our 3 drive pattern. That's the best we can do. We'll drive 1 off of the blue light, drive 2, drive 3. So we're picking up, that's the C right there. If we had to count this, that's what we'd do. This would be our C1 right here. Or I'm sorry. It'd be our A3. A3. Read the manual, Lan. Right there would be A3. And so that gives us a probability that this thing is going to end out. That is really tight, though. Break that blue light, come back down in here. And if that's the case, the less likelihood that it's going to come up there and break above and be above our red line. So if you want the market to go a little higher, but then you make less money, it's not worth it. So you got to buy one up here too. And you got to take 17 and you got to buy one out here. Ugh, that's why these are way out here. We're going to sell them out here, 5,000 of them. Okay, so there's your vertical spread right there. So the game is, and are you going to make any money? 0.98% risk on. Wait, are we buying that? Did I do that right? No, I did it wrong. I did it wrong. I don't want to delete the multi-leg. Just delete the. Well, oh, it's not going to let me just delete the one. I wonder if I can just change it because sell to open. I want to buy to open. Buy to open. Buy to open. There it is. Let me switch it. Okay, that's better. Now we're going to make 2.8% or $14 on our $500 investment in 28 days. As long as the little snaky thing, this little colored snaky thing stays below that red line. All right. It's got to stay below the red line, hit the purple line before underneath the red line. Then we got to keep our whopping 2.8%. But 2.8% is not bad. Don't complain about 2.8%. Some people wait an entire year to make 2.8% on their money. We're going to make 2.8% on our money in 29 days. All right. So keep that in mind. If you do that annualized, let's just do 3. Let's just say it's 2. Well, let's do 2.8 because that's what it is. It is what it is. We don't need to fudge it. 2.8 times 12. That's 33% annual return. Who's going to complain about making 33% annualized return with a 87% chance of making that pay off? That's pretty good. Can't complain about that. It's not very much money, man. It's only, you're going to receive $14. Okay, we'll do 10 of them. What's my investment? $5,000. So I'm going to put up $5,000. I'm going to get 2.8% or 33% annualized return, $140 in 30 days. As long as the little snaky thing stays below, hits the purple line underneath my red line. Yeah, look at that. Jay saying, my buddy was excited to get 4% on his CD. Now, there's a difference. Your buddy who's getting his CD has a 100% chance of getting his money. As long as he waits that entire year, right? Puts his $5,000 in there for 1 year, he's guaranteed he's going to get that 4%. This is no guarantee. It's only got an 80% chance, 87% chance that it's going to give you the money. 87% chance. So that's why you get more. You get 33% annualized return, but you got a chance of losing your money too. All right. You got a chance of losing your money. So that's the game you're going to play. So the better you are at trying to figure out where this snaky thing goes, the more money you can make. That's why this little book is so important, because this little book helps you count, measure the Aladdin algorithm. That's why that's so important. All right. So you can understand, learn how to count and measure these things with your little A1s, A2s, A3s, A4s, A5s, A6. What are the odds? That's what you're playing. It's just a carnival odds game. Okay. Jay's like, just do it already. Okay, just do it already. Just get it done. We got her figured out. We understand. Get her done. Okay, let's go on to the next one. Let's do we really want to do this one? It's not worth hardly. It's taking $5,000 out of our thing for $140. I think we can use $5,000 to make $140 somewhere else. Better use of our money. That's the question you have to ask yourself. Do you think we can have a better use of our $5,000 somewhere else? Put it on, Lan. Just get her done. Okay, let's come down here. We'll just put it on. You got plenty of money. All right, it's on. There it is. We got it. Wait a second. How come it didn't attach those two together? Chart. It's reading them as an individual single. It didn't hook them together. That's weird. If you want them hooked together, let's hook them together. I'll show you how to do that. We're going to come in here and we're going to, we got to do it down here. We're going to come in here and we're going to right click on this and we're going to tell it that we want to manually link the multi-legs. Why didn't it link them before? They should have linked them. We put them both on at the same time. So we're going to come in here and this is the 67 and the 72. So the 67 is already down here. We want the 72. So we're going to grab the 72 and add the single leg, and we're going to hook those together. Now we got a little line between them. And down here in accounting, they should now read, if we go multi-leg options, there we go. Now they're hooked together. See that? And they read as 1 instead of 2. These two we don't hook together because this has got a 332 days and this has got 29 days. So we'll read those as separate. But these two I wanted hooked together and have the math done down here in accounting. See how they're hooked together now? See that? That's really cool. That was a good little lesson. All right, Lan, get on with it. All right, here's Misty. Okay, so what we did here is we put this in. If you remember, this is MSTY. This is not MSTR. MSTY, this is a yield max fund, and I wanted to get some shares for our account, I wanted to show you how we could get some shares using an option. And I wanted the shares at this price level, not that one. So I put it in there to bid for it. And I said, I'm not giving you what you're asking because the yield max options have really horrible spreads on them. All right. So I said, if you're not going to give it to me at the level I want, I'm not going to take it. So I put a limit order in there to buy some more shares of Misty, but I did it with a put option. So they're going to pay me $200, and it was sitting there open for days. You guys came and saw it. This option was open for days, but they finally filled it. So they finally gave me what I wanted to get this price. Now, all that means is that the market moved in my favor. So I got the shares. I actually got the put option, which is going to receive $200 at my stated price. And so now my hope is, right, because I want the shares so I can get the dividends. Now they're going to give me, that's how many did we do? One. So they're going to give me 100 shares. So that's the whole point of that. I want those 100 shares. Now, if they don't give me the 100 shares because the market doesn't fall and come back down and close and hit, well, this is 57 days out. That's all I could do. So the market would have to come down here and hit that purple line underneath my red line, and then I'd get my money. All right, because this is a sell put. We were doing sell calls up there, so that meant it has to stay below the red line when we did the calls. This one here is a put, so it has to stay below the red line, hit the purple line underneath the red line. Then I'll get my 100 shares, but I'll also get my $200. So if it stays up here and hits the purple line, I don't get my 100 shares. I only get my $200. All right. So I don't get my 100 shares, which is fine. That's what I want. I want 100 shares. And I'd get my 100 shares at that red line price. And I'd get my $200 if it closed below and hit the purple line down here. But if it hits the purple line above, I don't get my 100 shares. I only get my $200. Okay, that's that one. NVIDIA, same thing, same situation. We're getting ready to see this thing flush, but the blue light's still quite a ways away. We got more to go. I think it's going to have to, I don't know. It's going to merge. It's going to come together. All right. So look, it did that. The blue light did that thing again where it came in early. I want to see the blue light come in a little bit more natural, like right down in here. But that's a 3-drive pattern off the top. There's drive 1, counter trend, drive 2, counter trend, drive 3. And it did that stupid thing. So I'm going to call this, well, it there again, it went so strong it didn't give us the little 3-drive mini pattern. It just went up. We got the little, look, we got a little pennant formation here, almost a little one there, another little pullback there, and that's it. But it's going to intercept the blue light. So when the interception of the blue light, we're going to go off the peak right here, Fibonacci, and we're going to make the adjustment up to there, and then back down to here, and that's where we're going to expect it to go. We'll have to see because it might break a new high, and then we'll have to make adjustments. So this is our delta Kona probability. That's where we think that thing's going to go to. So we could go in and put a vertical spread on here. We already sold our call, so we're going to make $2,500 on that. That's good. How much are we up on that position? Are we up? We are. We're up $287 right now, and it hasn't even started to fall. Come on, baby. Now, if it falls, of course, our long position is going to lose money, but that's okay because it's got how many days? 302 days. So it's clear out into next year. Because we're going to ride this one up 3 drives. We want to see this go up 3 drives. We'll take it off at 3 drives when it peaks out at the top of the 3rd drive, no matter what, no matter how much time we got left. We want to see this thing do a full 3-drive L8 wave. Drive 1, we want to see it pull back. We want to see drive 2, pull back. Then we want to see drive 3. When it gets to the top of drive 3 and it starts to pull back, we're going to take this long position off. All right. Because that'll be the top. And it might go up to a 4 drive. Nobody knows. But at 3 drives, that's the peak of, that's where we're going to try and take this thing off. It might only go to 2 drives and then flush back down. Nobody knows, but our goal is to see it go to the 3rd drive, and we'll have to measure that along the way. Let's go to SMC Super Micro. Did you guys want to put one on NVIDIA? In the interest of time, we'll let you guys go do that one on your own. Actually, let's look at it real quick because this could be a good one. Got lots of volume, lots of openness. 29. Oh, this would be a much better one to put on. That's where we're at here. We could look at this. A whole bunch of them right there. whole bunch of them right there. There it is. So if you sell this one and you buy this one, you can see them in the chain. That's what everybody's doing. There's your vertical spreads right there. You could be a little bit further out if you wanted to. You could, if you're worried, just get rid of all the drawing tools. If you're worried that little snaky thing is still going to hit the purple line above that red line, you wouldn't want to do this one. But we think it's going to come back down. But it could just do a little thing here and then go and still do that. Could still do that. You never know. But how much would that give you? That would be a 21% return. That would be a nice return. Receive $100 against your $500. Ooh, that's nice. This is a lot better than the last one we did. We could even go out a little further and be a little, see this one, what's the odds on this one? This is only 70%. Usually we like to do 80%. So we could bring this all the way out here. And then that one would have to bring it out all the way out here. Let's put it right there. What would that give us? That would be receiving 13% return. And look how far out that thing is. That's that would have to, that market. We could probably take a bigger risk than that. That's an 80% chance of being right. And the market would have to hit the purple line above that red line and to lose your money. You're only going to make $40, but it's still 13% return in 29 days. All right. So, yeah, we could put that one on. There's only one. You could just, let's do 10 of them. There you go. 13%, that'd be $400 on a $3,000 investment. And that market had really high probability of success. That market would really have to rally and go hard to be above that red line. You could do that one. Let's see if we can get it on. 40. Oh, it's tight spread. See if it'll take it. Nope, not going to take it. Let's try it again. Oh, 39. Let's go 38 just to see if it'll push it in there. There we go. All right, we got it. So that's a good deal. That'll make a lot of money. We could have done a lot more. And it connected them. See how they're connected? Got a little line between them. They're all on the same page now. All right, let's go to the next one. Let's go to Super Micro. Super Micro. So we got long positions in Super Micro. We got our long call and we got our sold call, 5. We did 5 against 5. And it's fallen. How much are we up? We're up $200. We're up $200 on our, oh, that's our 23 shares. So we got 23 shares. Remember when we did that? We put that position on at night and we got into the market. It didn't hit our stop and now it took off and rallied. So we got our stop at break even. We're just going to leave those on. How is this thing reading now? Drive 1, drive 2, that one ugly bar. Let's say this thing came down to here. That's a 3-drive pattern. Drive 1, drive 2, drive 3. And then it broke right here. And we've only got one. That Super Micro. That is an X3S A1. Is it not? Correct me if I'm wrong, but that's an X3S A1. I'm going to count that over here. That's one drive because it's down here too. So it confirmed in. It's right there. That's X3S A1. This is a little minor pullback. This is just a pennant. This is just a pennant. It's not the top of the market. Now, everything else is topping out. So you have to take that into consideration. Everything else looks like it wants to come back down to the Fibonacci cone of probability. But SM Super Micro, is that all we're going to get out of it? The 3-drive pattern was a lot more shallow. This market's a lot shallower. You would think that we would get a bigger run here. Huh. I don't know. I don't think we're going to come down and break the blue lights here. I think we're going to go again. I think we're going to come in here and this is going to be A2. That's what I think. Right there is going to be A2. If that's the case, I do not want that thing to rally against my short 5 calls. How much money have we got into those? Right now we got $372. Let's liquidate that and take that off. Let's just get out of that and take our profits. All right, so we closed out on this one, $360 gain. Go add it to your spreadsheet, because otherwise you won't know that you made it against your long call. You got to have the spreadsheet. If you don't do the spreadsheet, you're whistling Dixie in the wind. You got to have spreadsheets for all this stuff. That's the thing too, is I did a big old pontification lecture on the other day, what was it, Tuesday, about the yield max funds. And the reason these guys don't have any clue what's going on and why they can't wrap their head around what's going on with the yield max funds is because, first of all, the yield max funds are not like any other fund in the entire stock market. All right. They're brand spanking new brands. They've never done this before. That's why half these guys don't know what the heck they're talking about. And that's why they don't like them. They don't understand them because it's not what they're used to. They haven't done the research. They don't know what they're talking about. They don't know what these markets are. They have no clue. And I can guarantee you they're probably not doing a spreadsheet to calculate and figure it all out. You guys got to do spreadsheets. If you don't have a spreadsheet that calculates and follows all this stuff along, you'll never be able to figure out what you're doing. You won't know whether you're making money or not. You have no idea because you're not calculating and following it. This here, we just took off $360. Tomorrow, that'll disappear into the ether. It'll disappear into the cash account. We won't know. It'll never tell us on here whether that's making money or not. We don't know. It doesn't keep it for you. Now you'll get a statement and it'll tell you on the statement, but that's no more helpful than just seeing it here in the cash. It says, oh, you sold and made this, but it's just in a row, a column, just like writing a check on your checkbook. You don't tie the two together. You got to tie those two together in a spreadsheet. I'm telling you, it's important that you have a spreadsheet, and I've created one for you. It's right here. It's called the Poor Man's Covered Call Spreadsheet. And I'm not sure if I'm comfortable giving it to you yet, but I think I am. I think I'm going to include it. We can always make it better and give you the updated version. I'm going to give you this this month in the it's not pretty. I don't have like pretty columns and all the little boxes and the colors, but it works. I mean, the math is working. All right. So I'm not going to, I'll give you this spreadsheet in your Pit News magazine. When I send out the email, I'll give you a link to this spreadsheet, and you can start tracking your Poor Man's Covered Calls, because you got to track them with a spreadsheet. If you don't, then what's the point? I mean, what's the point? You got to track them. All right. So you got to come in here and track them. So this is your bought one, and then these are all of your sold ones. All right, against it. So this is the one we're doing for BMY. So I think this is an A2, and I think this thing's going to go again. So that's why I'm not going to keep that short position. I'm afraid if that market starts to go up, we'd lose our profit. All right, so let's go to the next one. Well, that's it. That's Spider. And we've been in here, and we've gone over time. All right, I got a Sunday school lesson for you. Let's go to just do the Sunday school lesson real quick. Sunday school lesson. Not my bull market. Yeah, he hates Trump. We're back to this again. The market's rallying. It's not, the reason this is so funny is because I had a buddy who did this. He makes those purple hair 42 nose rings and earring little girls that are hardcore left wing, he makes them look like they're far right. This guy is so far left, he should be living in Russia. I mean, he should be living in the Bolsheviks. I mean, that's how far left he is. And he refused to make money on the bull trend because it wasn't his trend. Don't do that. Don't let politics come in. I mean, you can listen to politics and you can say, I know what's it going to have an effect for the longer term trends of what's going to go on. But don't lose money. Don't not make money because you don't like the president, because of politics. Don't bring your politics into your trading unless it's just to kind of give you an idea of which direction you want to try and fill the market out for fundamentals, right? We trade the technicals, so we don't really pay much attention to the fundamentals because we believe that the fundamentals are already built into price. So by the time we get the fundamental information, the fundamental news, it's too late. The news that everybody has, that's not worth having. All right. So if you're hearing the news on on the newscast on YouTube, wherever you get your news, TV. If any of you still watch TV, do any of you still even have TV? I haven't had TV for, gosh, I'd say 15 years. 10, 15, yeah, 15 years. I probably haven't had TV for 15 years. As soon as they started having YouTube and videos and all the stuff, all the news, all the things that I wanted for news on YouTube, why am I paying for that? I don't even watch that anymore. So I don't even have it. Actually, I take it back. I do have it. Down in St. George, I have it because you can get a little antenna. You buy it off of Amazon. It's got a little antenna, and you can hook it on the back. And down in St. George, we've got HD TV for free through the air off of that big mountain that's up there with all the radar antennas. Did you guys know you can get a little antenna off of Amazon for like $39, and you can have like 30 channels, all your local news channels and everything coming in on HD with just a little antenna that you plug to the back of your TV? Did you know you could do that? Yep, you can. So anyway, I've got that. So that's my TV. But mostly I just watch the internet for my news. But I don't use the news to trade with. I don't pay much attention to the news. I believe that all the news, all the fundamental information that's in the news is already built into price. So we just need to watch price. And we use our mathematical models and technical indicators, and we kind of try to read the chart instead of try to read the news. Don't read the fundamentals. I had another buddy who was all about the fundamentals, and he hated the technicals. Now, that's not this guy. This guy likes technicals. He just he didn't like Trump, so he wasn't going to participate in the stock market. And he's a good trader. He's made a lot of money in the stock market. He made more money than I have, but he refused to make money here because it was a Trump run. And it was the same thing last time when the Trump train was going. He didn't make any money because he didn't like Trump. I was just like laughing. I'm like, you're a nut. Yeah, it is what it is. So be it. Anyway. That's all I got for you today, guys. And I hope you had fun. If you enjoyed the class, if you learned anything, and we need to go bigger. We need to get into, a summer class, because we got our 100 club. We need to go through our 100 club. That's this club here. And these are all the companies that broke 100% gainers last year. So they're probably pretty good companies, and we need to go through those and maybe start putting some things on those. So, all right, that's it. That's all I got for you. Thanks for the kind words, Kurt. And if you guys enjoyed it, give me a thumbs up, and we will see you not until next Tuesday. It's summer session, so light load. We'll see you on Tuesday morning, bright and early, 8 o'clock a.m. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.